The best lessons in life are often learned outside of the classroom. That's where all the action happens. That's where the rubber meets the road and the hard knocks knock some sense into you. But did you ever wish you could get those lessons without all the fuss? Sign up today and get your first week free. You can cancel at any time.
Hi, I'm Rick Brimacombe of Brimacombe Capital, and on behalf of Lessons from the Garage, welcome to our August podcast, an interview with Andrew Felbinger of Urban Innovation Fund. Lessons from the Garage provides inside learning for entrepreneurs. Think of Netflix for business owners and business leaders trying to grow their companies. There are over 200 videos so far, and will be about 300 or so by the end of the year. You can learn more by going to the website, www.lessonsfromthegarage.com, and sign up for a 7-day free trial. Check it out. Lessons from the Garage is powered by the Network Connect. The Network Connect is a platform created to connect investors, companies, preferred service providers, and act as a catalytic gateway to fuel business growth. To learn more about the Network Connect, go to www.thenetworkconnect. Our events and contacts have helped companies raise millions and millions of dollars, and our monthly newsletters reach thousands and thousands of investors and referral groups and tens of thousands of business contacts. But before we get to our interview with Andrew and learning more about the early stage venture capital market, I want to thank our sponsors, Schweigman Lumberg Wusner, otherwise known as SLW. It's an internationally recognized intellectual property law firm. They provide patent, trademark, and other IP-related services. To find out more about them, you can go to www.slwip.com. Without their generous support, these events would not happen, so thank you very much to Schweigman Lumberg Wusner, and please support them to the extent that you can. I've done a number of projects with them, both personally and with portfolio companies over the years, and I'm sure that they will take very good care of you when you reach out. As far as what the upcoming future looks like for the Network Connect, our podcast in September is with Collins Allen accounting firm, and they're going to cover basic accounting information for entrepreneurs. And again, we are brought to you by Lessons from the Garage, and we do have a free trial, 7-day free trial out on the website to check us out. So look forward to interacting there. Andrew and I interacted about a year ago or so when you came to Minneapolis, and welcome again to Minneapolis. Your second summer, you survived our first winter here.
I did.
I understand that you did a lot of skiing, both downhill and cross country, and last winter was a good year for that.
Took advantage of it. It was great to be here, and this winter was a bit more challenging than I might have expected, but I grew up in Chicago, so a little cold never hurt anyone.
Right, so from Chicago, you weren't totally surprised by the winter, although having ties with a Silicon Valley, San Francisco, Bay Area related fund, was this a short straw that you draw to come to Minneapolis?
No, not at all. Actually, I was actively looking for an opportunity like this. You know, as you mentioned, kind of being born and raised in the Midwest, I wanted to, really kind of excel within the early stage venture community, and I saw so many different markets that were outside of the main coasts, really growing exponentially over the last few years, and really wanted to take advantage of an opportunity where I was going to be able to go out and have that kind of freedom to go explore different markets.
Sure.
So was frankly excited for the opportunity.
Sure. So from Chicago out to the East Coast for college, ties to the San Francisco Bay Area venture firm, and now planted here in the Midwest.
Exactly.
All right. Well, we're glad to have you here. Tell us a little bit more about your fund. You got the first fund up 3 years ago, December, and I don't know if I'm jumping ahead on your presentation.
Not at all.
But the first fund you launched about 3 years ago, December of 16. It's a little under $25 million. You have 22 portfolio companies in that now.
Yep.
3 people, yourself and 2 partners. Tell us a little bit more.
Yeah, of course. Thanks, Rick. And you kind of gave a great 30,000-foot view. But so yes, we are the Urban Innovation Fund. So we're a venture capital firm that invests in startups shaping the future of cities, which is intentionally very broad. So we invest in everything from transportation to business and financial services and the future of work, and kind of everything in between, all with the hopes of growing and scaling to many US cities and hopefully beyond. We're an early stage investor, so we typically like to be that kind of first institutional investor in the door. So that generally means we're coming in around that pre-seed and seed bucket. And over and above capital, we do consider ourselves very hands-on, which takes a lot of shapes and forms. But one thing in particular we like to emphasize is political and regulatory support. So by no means a requirement for any of our portfolio companies to join the portfolio, but something that we've just found to be very effective and important for many of our portfolio companies.
Great.
But one of the questions,
Actually, before you jump,
Yep.
tell me a little bit from your definition, seed and pre-seed. What does that mean? Because different people have different kind of metrics around that. What do they need in terms of stage and maybe some traction and stuff? And again, if I'm jumping ahead on you.
No, not at all. These are great questions and ones that we get all the time. And it's interesting that you bring that up because there is very much a different definition of what's pre-seed and what's seed and what's Series A in different markets. What's pre-seed in the San Francisco Bay Area might be a seed or frankly even a small Series A in some smaller central US markets. So generally the way we like to think about it is that there are essentially like different stages. There's someone going and launching a startup. There's the typical kind of family and friends round. Maybe that's just pulling together some basic MVP or just getting enough money to scrap together and really see whether something's there. Then there's some kind of early angel round. And then we like to think of the pre-seed as that like first level of institutional capital.
Okay.
For us, that typically means anything under $1 million.
Okay.
That seed bucket is then kind of that next tier, and right now you're seeing seed rounds that are anywhere from $750,000 up to you're seeing $2.5 to $3 million seeds. Again, differs by market and everything else. And then a Series A now you're seeing at $7 million to you could see a 15 or 20 plus $1 million Series A. And one kind of financing tool that is often overlooked now is because of how everything has kind of taken a step up, what used to be a Series A might now be considered a seed. We're seeing a lot of the kind of seed extension rounds or seed plus rounds, et cetera, because the threshold to get to a true kind of institutional Series A is just so much higher now. That oftentimes you're seeing founders and startups that are looking to extend their runway or get bridge is a word that no founder wants to hear, and kind of investors can have a very divisive reaction to. But you're seeing a lot of those extensions and other kind of interim or pre-Series A rounds now as well.
Okay. All right. Great. Thank you.
Of course, but I think just kind of going back to our thesis, one of the kind of knee-jerk reactions people often hear when they hear Urban Innovation Fund is, that's fantastic, you invest in smart cities or connected devices, that's great. And while that's absolutely true, we like to think of kind of urban technology in a much broader sense. I think the broadest way we can think about it is we like to back startups and founders who are solving problems faced by urban dwellers. And so that's where, when you think about it like that, when you look at our areas of interest, those problems can be broken down into kind of three main categories that we define as kind of essentially urban challenges, which are the local economy and local government, networks and systems, and that could be things like food systems or transportation, even energy and sustainability. And then finally, human services, and that's where that kind of future of work, health and public safety, et cetera, falls in. And I often think it's also helpful to generally just give you kind of a snippet of our portfolio. You mentioned we have 22 portfolio companies. Usually that paints a good picture of kind of the diversity within our portfolio. And just kind of kicking it off and taking it in any order here, one of our portfolio companies is a Boston-based company called Catch. They are providing a comprehensive benefits platform for 1099 workers. So they're very much future of work, and the idea is that the way the world is working is changing. So many more people right now are engaged in side hustles or 1099s or a mix of W-2 and 1099s, but just don't have access to things like tax withholding, things like health insurance, life insurance, et cetera. So they want to be that kind of comprehensive benefits platform. Similar, sticking in that future of work bucket, is a company called Milk Stork. They're based out in California, in Oakland, and what they do is they are the first breast milk shipping service for traveling moms. So they actually sell directly to enterprise clients. So they partner with businesses, and right now they're in over 500 businesses. And those businesses and then in turn offer it as an employee benefit. So it's great for retaining employees and essentially everything else, empowering mothers and making sure that they no longer have to face that trade-off of caring for their child in the way that they want to and sacrificing their career. Coincidentally, it happens to be they're top of mind because it's National Breastfeeding Awareness Month, and they were actually just featured yesterday on the Today Show.
Great.
So had a great little clip there, but are doing great. I
Nice
think,
little plug there.
yeah, exactly.
Better advertising than you can even buy.
That's what I'm here for. Listen,
Yeah.
we're the anyone in our portfolio knows. Anytime they're in our portfolio, we want to be the champions of
Yeah.
all of our entrepreneurs and startups, and that's we take pride in that.
Okay.
But I think another interesting company is one that's also received quite a bit of press recently. Is a portfolio company of ours called Votes. They coincidentally are also Boston, like Catch, but they are a mobile voting via blockchain startup, and they actually made history last November for being the first ever, facilitating the first ever mobile voting in a federal election. So they partnered with the state of West Virginia, and West Virginia then in turn offered the Votes mobile voting platform as a way for their overseas military to vote and be engaged. That's something that's, not surprisingly, the stats that are out there, across the U.S. Are embarrassingly low, the engagement at the polls. So, that's another thing that's you might not necessarily assume urban innovation, but the engagement, the kind of government and civic tech, et cetera, we're really kind of proud at what they've been doing. But as you can see, the portfolio really kind of runs the gamut.
Sure. And you've made these 22 investments in a little over 2.5 years. You started investing December of 2016. That's pretty active just in terms of volume.
Yep.
Give the audience just kind of a quick overview as to how you get through that many deals.
Yeah, we are definitely active. We invest in around 8 to 10 per year. And we, for being a relatively lean team, we still, like to be out there and like to have a seat at every table, and that's why you'll often find me traveling to markets, obviously focusing on the Twin Cities and taking advantage of everything while I'm here, but also traveling and going to accelerators and meeting with other investors in markets like Chicago, like Denver, like Atlanta, like Austin. Other kind of similar up-and-coming markets. But we funnel through quite a few, and we'll actually talk a little later on about what our actual funnel looks like, which I think for a lot of people who are just starting and getting engaged with the fundraising process is kind of eye-opening to see what the numbers actually look like and allude to just kind of how challenging fundraising really is.
And your typical first investment in a company?
The size-wise?
Yeah.
So our typical check is anywhere from around $250,000 to $500,000.
Great, great.
But yeah, no, that's why, again, we like to be that first one in the door. But with being the first one in the door, it's often interesting because we're generally getting pitched by entrepreneurs and startups who pitching to institutional VCs is not something they're familiar with, or they haven't gone through a round of successful raise, and because of that, oftentimes we kind of have important feedback and other things that we see that we want to make it an easy process, whether or not it's a company that is the right fit for the Urban Innovation Fund or not. Of course we want to be able to help provide feedback and valuable support, and that's why I thought that it would be prudent to kind of have a discussion specifically around that kind of VC 101, what exactly it is that we're looking for and why venture capital may not be necessarily the right vehicle for everyone.
Sure.
Because these are often conversations that we have
Sure.
with people who are looking for that first round of funding and are just kind of dipping their toes in the water. And that's some of the feedback that we often get.
Okay, great.
But given that, I think just kind of kicking it off, some of the key lessons, I think the first thing, and it seems ironic coming from a venture capitalist, but the very first thing is that, for entrepreneurs out there, you don't need venture capital. A lot of people assume, oh, I'm creating a startup. Well, VCs back startups, therefore I need VC. Not necessarily the case. You can absolutely build a great business without venture funding. And I mean, a lot of successful entrepreneurs have never taken VC funding. Tuft & Needle, the direct-to-consumer mattress company, they've bootstrapped the business to just about $200 million in annual sales. Spanx is 100% owned by the founder. They have an estimated $400 million in revenue. So I mean, there's a clear difference between building a profitable and sustainable company versus building a venture-backable business. And I think that that's something that as a lot of markets continue to evolve and grow and the startup ecosystem continues to flourish, I think that education component will be critical. But there are other funding options that are out there. I mean, the one that, frankly, we're the biggest proponents of is customer revenue. It's non-dilutive. It's a great market validator. What's not to like? Obviously, it's easier said than done for some instances, and depending on the product, you'll need a team. You'll need some kind of funding to be able to get to the point where you can rely off of customer revenue. But nonetheless, there's no way you can go wrong with more customer revenue. Other sources are things like crowdfunding or one business subsidizing another, i.e. consulting work in order to get something off the ground and make a scalable business. And a thing that we often see, especially given our thesis, is we see a lot of grant funding, which while on one side the kind of non-dilutive financing can be fantastic and great for a startup to have an injection of capital, a clean cap table. There are also some risks that come with that. Oftentimes grants have a very specific use case that the funding could go for, and frankly, when startups are early and are pivoting quickly, that is a risk, and you have to be conscious of the grant, what the kind of purpose of the grant is, and making sure that that is aligned with exactly what the strategy is that you're finding. And now, granted, on the flip side, I'm never going to sit here and talk the whole time about how VC funding isn't for everyone, because obviously many of the world's largest startups, and it's funny, you can't really say startups anymore, largest companies have had a heavy infusion of venture capital before exiting and going public. Obviously, the FANGs of the world are what everyone is talking about right now, and how they've just absolutely fundamentally kind of changed the game in the last, X years. But that said, because of those kind of success stories, there's tons of hype around VC, even though when it all comes down to it, fewer than 1% of companies who are going out and searching for capital actually wind up getting venture money. So despite all the hype and success, it's still very scarce and a difficult thing to come by. Oops. And now that said, I think discussing more in detail about kind of what exactly it is that we're looking for, and we meaning VCs when we're getting pitched is important. And in order to really understand that, it's important to first kind of understand how venture capital works. So, I mean, just very simply, with regard to VC fund mechanics, we have a VC has a fund that we invest in startups and create a portfolio. We discussed our portfolio of 22 companies. Now, just as we are investors in our portfolio companies, we have investors ourselves, which are called LPs. They basically are the ones that pull together the resources to create the fund, in our case, just under a $25 million fund one. Now, in turn, how do we make money? We essentially make money when our portfolio exits. So that exit could be an IPO, it could be an acquisition. And from there, typically, our LPs will take roughly 80% of the profits from the sale, and we will take the remainder. So just broadly speaking, there's kind of three main stakeholders in this kind of VC fund mechanics, which include the VC fund, which is run by general partners or GPs, the LPs who back the VC fund, and of course the startups who all make up and compile one portfolio. Now that said, we talk a lot about how VC funding isn't for everyone, and the reason is that VCs have a very different mindset. You're often looking for, essentially the unicorns, the companies that can return the kind of entire fund, and the reason being, startup life is risky. When we're building our portfolio, we know from statistics that 70% of startups fail. So with that in mind, VCs create this portfolio, and while of course, everyone wants every company to have a successful exit and grow and flourish, you have to kind of plan as a VC to have essentially 1/3 of your investments die and return nothing, 1/3 of your investments to about return what you put in, and then the remaining 1/3 to deliver the vast majority of the returns at a 5 to 10x multiple. And so in fact, historically, 80% of a typical VC's returns are generated by just 20% of its investments. And so as a result, that's why VCs really need the billion-dollar exits. So for example, if a typical kind of Series A VC, which might be 200 million in total fund size, if they're looking, every deal you have to have the expectation that it can return the fund. And so if you're taking a 20% stake, you need to have the exit to be $1 billion. You need a unicorn. Unicorn, of course, being $1 billion exit, which is why any single time that a VC is being pitched, you're always talking about what the ambition is and what the ceiling is and where you can grow. It's not necessarily about the short-term, kind of sustainability, profitability. We're going to make a really strong $10 million business that's going to churn out, 50% gross margins. We're never going to need to raise $1. That's great, and it's probably an extremely successful business, but may not fit the kind of VC mentality. And now that said, we kind of mentioned, you brought up the question about, how many deals do we look at? What does that process look like? And I think it's really interesting talking about what our actual funnel looks like and actually how, our funnel almost fits to a T just about every other VC out there. And, you can look up data, it's widely available, but we're a company of 3 people, a fund of 3 people. We, on average, will look at about 1,500 deals per year, so roughly 500 per. Which is a lot. So we have no problem getting out there and love talking to accelerators, to other investors, going to pitch events, et cetera. We want to have our finger on the pulse and see everyone. Now, from those 1,500 deals, we'll take 5 to 10 intro meetings per week, and that could be intro meetings that are warm intros from other investors. It could be intro meetings that we set up directly. It could come from cold outreach. But from those intro meetings, while as important of an intro meet as important as landing that intro meeting is, I think the first incredibly powerful sign of engagement from the entrepreneur's perspective is getting to that follow-up meeting. So we right now have on average about 100 follow-up meetings per year. And that right there, just getting from the 1,500 to 100 follow-up meetings, that's a challenge, and that's regardless of whether or not it works with us, our fund, or any other fund, that is generally, a validation that there's something there, whether it's the team, whether it's the market, the product, and that should certainly be an encouraging sign. And that's also not to say that if you don't get to a follow-up meeting, that, there's something wrong with my business, because every VC has a different value add, has a different thesis. Maybe it's too early for us. Maybe it's too late for us. Maybe it's, we're no longer, we're over-indexed in one specific area within our thesis, and we're no longer trying to focus on that. So, as kind of powerful as getting to that follow-up meeting is, I think it's also important to note that if you don't get there, that doesn't necessarily mean that that the VC that doesn't bring you to that follow-up meeting doesn't believe that you're going to be successful. It just might not be the right fit at that time. But that said, as powerful and important as a message of getting to that follow-up meeting is, we only take 30 people into due diligence, and only invest in roughly 8 to 10 per year. So even when you get to that follow-up meeting, there's still a 8 to 10% chance that you're getting funded. So it's still smaller than or fewer than 1% of the companies that we actually see get funded. So it's a slog. Fundraising is not easy by any means. It's a challenge, but there's a reward at the end of the tunnel, regardless of how things kind of transpire. But it's something that I think, as long as to be an entrepreneur and to really succeed in fundraising, you really have to know exactly what it is that VCs are looking for, kind of how they're viewing things, and the realities of, you can't start a fundraising process with a list of 10 investors and say, this is great, I'm going to be able to fill out my round with 3 of these people and it'll be fine. You need to be prepared and have a detailed list of all the investors at the right stage, able to, then you're able to go out and blast out and get warm intros to hundreds of investors, and kind of coordinate that all together.
Can I just touch base on that comment there about intros? So let's say I have a business, I want to reach out to you. Is the best way, and maybe there's an answer to you specifically, but
Yep.
then there's an answer to the venture industry as a whole. If I go straight at it, is that the right way to do it? Do I need to go indirect through somebody who knows you to get the referral, so it's a warm referral? What's the best way to approach the fundraising?
Yeah, I mean, I think every fund does it differently. We are very, take a lot of pride in our inbound box, which is our pitch at urbaninnovationfund.com. And we're also, very open with, entrepreneurs reaching out directly to us, cold emails. We will absolutely review all of them, which is challenging, but it's something that, again, we like to take pride in. That said, I think if I'm an entrepreneur out there, the easiest way, and it's, again, maybe not easy, but the greatest likelihood of success would be coming through a true warm intro. And I don't think it's worth it to really force a warm intro. Don't go out of your way to kind of see if you can create some third connection that's somehow tangentially, this person somehow worked with Andrew 4 years ago, might not actually know him, but I saw this on LinkedIn and I'm best friends with his cousin. Like, don't go crazy trying to find that. But oftentimes, whether it's coming from another investor or another colleague, or VCs see so many deals. If they can get a warm introduction from someone who they trust, that's an important thing. It doesn't necessarily have to be an investor, but just someone who they trust and know wouldn't necessarily be giving them something that is, that doesn't fit, or is, something that's not serious, et cetera. I think that's important, and that's a great way to stand out.
Okay, all right, thank you.
And all that said, because it's so challenging, one of the things that I think is important to think about is, of course, you need to really focus on the business and everything else, but when you're talking about standing out in terms of all of these meetings, it's incredibly important, because 1,500 companies per year, we invest in 8 to 10. You do need to stand out in order to catch our attention, and you need to stand out in a variety of ways. And I think that there are a few kind of key important ways to do that, to set yourself up, that go over and above just having a strong business, a strong product, and everything else. I think first and foremost, it's knowing when to raise and who to raise from. So as I mentioned, it's important to really kind of create a curated list of exactly who it makes sense to reach out to. What's important is, okay, if I'm just getting off the ground, I don't want to go send a blast email to, I know, my old college buddy works at Sequoia. Perfect time to talk. It's not the perfect time to talk. They don't invest in something like that. When you're just getting off the ground and you're not full time, that's when you need that family and friends round. Put something together. Throw up some kind of MVP. When you're, had some like early proof of concept and are looking and getting ready for that first kind of institutional financing, to say, all right, we've done this, maybe it's a 3-month pilot, or we've put together this basic MVP of this technology, or we've brought on these engineers and are working with a development team overseas, and like, here's basically what we've done, and now we just need some money to do it. That's when you can start reaching out to that pre-seed type financing. If you're looking to raise that $500K to $1 million, $1.5 million, That's when you need to start curating that list of micro VCs or looking at the right angels and angel networks that are out there. Similarly, when you're getting to that point where you have the product launch and you need some customers and you're getting ready to raise that $1.5 to $3 million, that's when you need to get that seed bucket. And the Series A doesn't come into consideration until you might be at that $1 million ARR mark and you're really ready to really put fuel on the fire. And that's essentially why I think it's so important to have that like pre-seed and seed bucket, which is where, again, we like to excel because we want to be that first one institutional in the door and really help professionalize and get our portfolio companies ready for that big institutional Sequoia or Norwest or General Catalyst, where they have the deep pockets to be able to take something to an exit. But prioritizing and being very truthful about where you are in your company's life cycle and getting the right list, as simple as it sounds, is something that is often overlooked.
Sure. What about getting a kind of first look, even if they're not raising money? So I have a business, I'm not quite ready for you, but I know that this fits into your sweet spot. Are you open to hearing from an entrepreneur saying, I'm not raising money now, but a year from now, but my company, my product fits right into what you're doing? Or how do you handle that, and what would you recommend to somebody who is thinking along those lines?
Yeah, it's funny. We talk all the time with our portfolio about that and with other entrepreneurs and just discuss internally. It's always great to, we personally, we would always want to have a conversation with an entrepreneur that is too early for us as opposed to too late. We love that because then, okay, it's a compelling business, we like the team, we like what you're after, but it's just a bit too early for us. Go get a little more proof of concept, raise, a couple $100,000, and then come back to us when you need that kind of more institutional money. That's great because then we can kind of track that progress and see how everything's going. Now, on the flip side, one thing that I think is important is you don't want to have too many touch points. And the reason I say that is because it's much more powerful if, let's say, I went and I saw the Urban Innovation Fund last June, and I was at $100K in ARR, and I had this great product that was just launching, but it was just a bit too early. If I come back this June, June 2019, a year later, and I've finally brought on, it wasn't just me and my co-founder anymore, I brought on 3 full-time employees. We've grown, and now we're at $300K in ARR. We've grown into X more markets, whatever it may be. That's powerful growth that shows really strong growth in a short amount of time. Now, let's say, for example, you go after that June meeting and you come and talk to the Urban Innovation Fund in September, and you went from 100 to 130K in ARR. And then in December, and it's 170K in ARR. It's just, it kind of takes away the actual growth.
Like anything, moderation is important.
Moderation is important. Like, show that, 2x growth or 3x growth is great. Don't do yourself a disservice by trying to give, we just signed another $5,000 contract, and then a week later another $2,500. Like, it's just, it won't have the same impact as waiting is.
Yeah, gotcha.
And I think another important thing is just really knowing kind of really how to pitch, and more so than just kind of the simple things like keeping your emails short. We go through 1,500. How do you use attachments effectively? How do you get, cut to the point? Why is this email important to me at the Urban Innovation Fund? How specific is it? Have you researched, the VC ahead of time? I think in a hugely impactful and simple thing, but something that often resonates very well, speaking from experience, when an entrepreneur sits down, and I might give a quick overview on the Urban Innovation Fund, and they might have an adjacency to one of our portfolio companies, and they can say, I saw you're an investor in Catch. We think it's super interesting, and here's what we're doing, which has a similar alignment to that. Obviously, you don't want to be a direct competitor to something. That also shows if you don't do research. But if you can articulate something like that, it just shows a level of professionalism that goes a long way in the sense that, if we're investing in an early stage company, that's impactful because we know it's someone who really cares, will go the extra mile and work on that. And it's those little things that will be endearing and allow the VC to really engage and understand more closely. So I think that's super important. And as simple as it is, being on time and being transparent and open is unbelievable. Every VC does it differently. I personally, I'll ask for a deck ahead of time, and I'll generally ask, every single time if I'm exchanging emails, I'll ask the entrepreneur to plan to share their screen if I'm on Zoom, or if it's in person, just kind of flip through and actually flip through their deck and walk through it. More so, it's not like a pitch, but more conversational, because I think the line I always use is, it's great for me to read it, but it's so much more powerful hearing it from the entrepreneur's voice themselves. And I'd say 15% of the time or 20% of the time, entrepreneurs, despite the fact that I might have a 3-sentence email confirming a time, and one of those sentences is, please be prepared to share your screen and walk through the deck, 15 to 20% of the time, they won't do that. And it's, you could have the best company in the world, and I'm not going to say that that's an automatic, oh, it's never going to happen, but that's a challenge. If an entrepreneur can't, take a simple, if you can't trust like a simple instruction, how can you trust them to build that business?
It's a red herring.
Exactly. So it's little things like that are, it's funny talking about like how to pitch. Everyone's going to sit there and go like, oh, well, that's, it makes sense, it's obvious. But sometimes, just doing all those things is something that will help separate you. If you're on time, if you're professional, if you follow up, if you're specific and relate to each VC, it's just spend the extra 20 minutes before and really tailor it to the right VC is exactly how you kind of stand out. Now that said, there's as many ways as there are to kind of stand out, there are equally as many ways that are just straight deal breakers. And more often than not, these are the things that are, the kind of when we're giving feedback to any companies that we're passing on, and we might be passing on 99% of our companies. So feedback is incredibly important, and I think that it helps shape. The entrepreneurs who really ask for detailed feedback and really value it, I think, are the ones that are able to go on and continue a successful raise. But talking about like deal breakers is really important, because I think it goes to what I was saying, which is you need to really know what you're doing when you're kind of launching this fundraise, and you need to know kind of what your strengths are and what potential weaknesses are. So for us, there are a few things that are big red flags. And I think the first and most common one, one of the most common ones is an unconvincing market size. Now, it's a challenge, and for us, there's not really a number that we'll necessarily put on it. But in order to truly be a venture-backable, unicorn exit, you really have to show an ambition and a market that is compelling. You can't necessarily own I'm going to have this very specific product that is going to dominate this $200 million market. $200 million in revenue sounds awesome, and any VC would love to have an early stage VC would love to have some company that gets to that. But it's impossible to assume 100% market share in something so small. That market size is generally one of those kind of first things that we'll really push on, and we can be asking an entrepreneur about what their ambition is and what their grander vision is, and what we're trying to really understand is like what their mindset is. Are they going to really kind of carve this like really niche thing, or are they going to use this as their kind of beachhead market to grow into whatever these adjacencies are, and so on and so forth.
Okay.
But I think market size is interesting, and that's something that we when we're talking, obviously when our portfolio is going and talking to, the major kind of Series A and Series B and beyond funders, it's something that's even more important for them.
Sure.
Which is why it's kind of funneled down to us.
Is there a, and I know you don't want to put a hard and fast number, go, no go, but is there a number that you just kind of internally say, okay, that feels big enough?
Yeah, of course. I think, For us, something that's a $10 billion plus market is a good way to get started.
Okay.
But often what's interesting is, because again, we're generally that kind of first level, our idea, an entrepreneur might come and they might show a slide that has a $1.2 billion market size. And we might look at it and say, oh, well, we would never invest in something that is truly like a total addressable market is just $1.2 billion. But we might look at it and say, they're just getting started. They're not thinking about what the actual, what the true kind of adjacencies where they can expand into. And we might be able to look at it and say, well, if this, given what their vision and their ambition is, we can pencil this out to a $20 billion market. So we'll certainly take what the entrepreneurs give us, because that's important, but that's why we kind of push and ask for what their vision is, because sometimes they don't even know what their true market is. So we'll take what, and on the flip side, someone could say, oh, this is a $50 billion market, and we might look and really push them, and we might say, based on what they're saying, it might be a much smaller market. So we're kind of, you want to take what an entrepreneur says with a grain of salt, but that's why it's important to really get an understanding to their vision.
Got it. Thank you.
Another common one, especially early on, is this concept of raising multiple rounds. The most common is hey, we're XYZ. We've raised $1 million, $2 million to date. We've had early conversations with Series A investors, and we plan to close our Series A in 6 months. But we're just closing out a convertible note from a seed extension round for a couple $100,000 that'll buy us a little more runway before we close the Series A. It's amazing how often that comes up, and it's something that just makes you sound inexperienced. It makes the current deal more risky. It incentivizes waiting. There's no reason. And if I'm a Series A investor and I see that you just closed a convertible note, for $200,000 or $300,000 3 months ago at a $10 million cap, then why am I expected to give you a $30 million valuation 3 months later when you just closed that? There's just a lot of misalignment that is generally a red flag for both the kind of larger investors that they're going after and that kind of those kind of bridge or extension investors that they're trying to close out the note. So that's something that especially in today's day and age where, like I said, the threshold for getting to a Series A is so much higher now, and the importance of runway, kind of doing this kind of multiple rounds at the same time is a challenge. And that, I think that also, not that, I won't necessarily call a seed extension round a deal breaker by any means. We've done seed extension rounds and think they are valuable, but you have to go into a seed extension round knowing that you are going to raise the threshold of the already higher thresholds of a Series A. When you're out there and you're raising another kind of $1.5 million, $2 million on top of the seed money you've raised to extend your runway for another 2 years, you're basically you're pushing up the threshold that what you need to get to that Series A even more. So it no longer might be that kind of $1 million ARR check mark that you get. Because you just had that injection of capital, you're going to have a larger cap table. Series A investors will expect you to have stronger growth. So while it's important and you really need to prep for that, that's also generally why I'm never going to be out here and push for kind of dilution for dilution's sake for an entrepreneur. But we always encourage raising more than what the kind of initial gut reaction is, because I think having that extra runway, especially in a time like now where no one knows what the fundraising environment is going to look like over the next 24 months, it's important to have that extra runway. And given that a true kind of institutional fundraise can take 6 to 8 months minimum, having an extra 6 months might be worth the incremental dilution that comes with it by raising slightly more than is expected. This is all, of course, assuming that you can raise what is expected. But it's just important to understand that a seed extension does kind of essentially bring up the expectations
And as
accordingly.
folks look to pick a number to raise and they look at the timeline that they're raising that for, typically they'll look at 12 months, 18 months, 24 months.
Yep.
Do you have a preference as a firm as to what they should be thinking about and looking at?
It really depends. It's very situational. There are sometimes reasons why a company may raise just for 12 months. Maybe they're just launching a specific product, or they're, or something kind of unique that's going to happen in 6 months, and that's what they'll need. They'll need to have that kind of early traction and early product launch, where then they'll be able to go out in 12 months. Like, you always want to be able to articulate a story. I think that's what's super important with early fundraising. You want to be able to show not just, because revenue growth always isn't a story, but you want to be able to say, here's how we changed. Here's how, when we got money in March, we got money and the intent was to launch our product in September. And with that launch in September, we were able to get the next 6 months to have great traction and great growth. And that was the early traction that we needed to get that next level of investor. That might be the story. Another investor, it might be, hey, we're going to take this free product that we've spread to all these different cities across the U.S., and we're going to spend the next 18 months converting them from this free product into a fully paid contract. We're going to change some of the actual underlying usage, and we're going to really start to monetize it. That might be an 18-month window. I would raise for that. You always want to go in and just kind of look at, if you're getting a seed round, say, all right, what do I need to kind of backwards map to the Series A? If I'm at a pre-seed round, what do I need to backwards map to get to the seed? And how does the narrative kind of fit into that, and how long will that narrative take, I think is incredibly important. And I think another important deal breaker is really having what I'll describe as bad market trends. And it's funny, this year, which is really kind of the year of all the big sexy IPOs that have been causing lots of news, it's really become very apparent. Things like, obviously everyone's talking about profitability with companies like Uber and Lyft, and whether or not they'll ever be profitable. Similar with WeWork and the news, coming out about their pending IPO, and just the capital intense nature of it, and also profitability concerns. I think those type of market trends ripple down to early stage companies. Is using a fleet of 1099 workers, will the unit economics work out at scale? Well, maybe 5 to 7 years ago, when Uber and Lyft were blowing up everywhere and people were elbowing everyone they could to be able to give them money to do that, they thought, listen, with scale, it'll work. Well, that hasn't necessarily been the case right now, and there's uncertainty about that. So a company that has a similar business model, using a similar workforce and the same kind of concerns, might not have the same levels of success raising a seed or a Series A round nowadays because of that. Similar to WeWork, that capital-intensive nature right now, you're seeing a lot of pushback in the early stage environment about companies that are incredibly capital-intensive, and it comes from the top. The pinnacle is, of course, 3 years ago, early stage companies were saying, well, we're going to be the WeWork for X, or we're going to be the Uber for X. I mean, Uber for X was, you could probably have 1,000 different startups that were calling themselves the Uber for X. You're not hearing that much anymore for a variety of reasons. And I think those type of market trends come from the top, and they do impact early stage. So you really need to be very cognizant about what the kind of true market trends are out there for your business. And I think that's something that it's not necessarily, if you're a capital intensive business, that's fine. It's not an automatic no, but you need to be able to come prepared to have an answer for how you're able to defend that, and how you're able to get to profitability, and where is this capital going to come from? How are you going to be able to respond to that? Is something that you need to be armed with from the very first fundraising conversation. It could be before you have, whatever it is that is capital intensive. It can be before that, and you still need to have an answer for it. And I think that the last the last deal breaker is really just some, crazy valuations. And right now, valuations kind of across the U.S. are really, they've gone up dramatically. If you look at stats from CB Insights or PitchBook or anyone who's compiling it, the Series A valuation has gone up 50% in the last 5-10 years, and that's challenging because that's leading to more of those seed extension rounds and some of the challenges that we discussed earlier, or an entrepreneur in a cap table's worst nightmare of a down round. Those are obviously huge red flags and things that investors will be wary of and be cautious of. You're especially seeing a lot of angels who are out there, and angels might be less valuation sensitive than venture capitalists or venture capital funds. And from an entrepreneur, the answer might not always be, I'm going to get the money with the highest valuation.
Absolutely. Absolutely, yeah. This one drives me crazy because entrepreneurs don't understand the math. And the math of a valuation or a valuation that's too high really corners an investor, and they can't get the kind of returns they need. And so I think, and it's not that they're have ill intent or anything like that. Of course, it's their baby. It's the prettiest, cutest, most loving baby ever, so they want the highest valuation. But they don't understand that then the downstream investors can't get the 5 times, 10 times that they want. And so I think the entrepreneurs woefully underestimate the importance of pricing a deal right.
Absolutely. I mean, building a cap table, especially early on, is just as much art as it is science, and it's important to balance that. I mean, I think a cap table that has the right blend of angels and early VCs and institutional VCs, like, you can set yourself up for success, but maybe more impactfully, you can really, kind of punch your ticket, punch your exit early and your downfall by messing that up early and preventing people.
Absolutely.
So, and that's something that's it's tough when you have a compelling product or compelling vision to have cap table challenges be the reason why you can't get an investment from the right partner that you need.
Right.
But we see, as I mentioned, 1,500 companies and all of these kind of different trends. Obviously, every company is different, but hopefully some of these kind of high level deal breakers that are kind of our usual deal breakers are helpful and insightful, and hopefully kind of some of the overviews of how to stand out and just a little more about us has been impactful. But
Sure.
But I hope this has been useful.
Very good. Thank you for joining us. If you were to just give one last nugget or 2 or 3 to kind of tie it all up in a bow, what would that be?
Boy, I think first and foremost, I am obviously biased in the sense that, I feel very fortunate to be in a unique position with a fund that has both a coastal presence and a Midwestern presence. I very much do believe that, and this is my personal opinion, I very much believe that, fortunately, the way the world has evolved, I do not believe that you need to be a startup in Silicon Valley to have a major successful unicorn exit. And I think some data is showing that. I think that there is talent out there, and I think that the ecosystems in the central U.S. are growing. Not to say that if you're in San Francisco now or if you're in New York now that you need to leave by any means. But I don't think that that's a barrier to entry as it may have been previously. So I think that's incredibly encouraging, and I think it's amazing looking around, seeing how impactful the startup world has been on all different walks of life. It's no longer, not that it ever necessarily was just, this kind of niche area that targeted just, improved enterprise or, other kind of high-tech, industries. But now, and especially with the Urban Innovation Fund and our thesis, I mean, we do see companies and, really like to back and push companies that have a profound impact on essentially all urban dwellers, and that's hugely expansive. And companies that are making it easier for women to breastfeed and also grow in their career, and making it easier for 1099 workers to have access to things like health insurance and tax benefits. Like it's great to see companies that are having a profound impact kind of across verticals and across industries. And at the Urban Innovation Fund, our door is certainly always open, and we would love to hear from anyone and everyone. I always encourage, as I mentioned, directly reaching out to us. You don't necessarily need to have a warm intro. My inbox is always open. It's simple. It's andrew@urbaninnovationfund.com. But we'd love to hear from the next great startups, and hopefully we'll continue to add to our current portfolio and add a bunch more great startups to it in the coming weeks, months, and years.
Great. Well, thank you very much, Andrew. Appreciate it. Thank you. And again, today's event was brought by Schwegman Lumber Woosner, the intellectual property law firm that has been our ongoing sponsor of this series. Lessons from the Garage, again, provides inside learning for entrepreneurs, folks trying to grow their companies to be bigger and more profitable. And you can learn more about us at www.lessonsfromthegarage, and we will see you next time. Thank you.
The best lessons in life are often learned outside of the classroom. That's where all the action happens. That's where the rubber meets the road and the hard knocks knock some sense into you. But did you ever wish you could get those lessons without all the fuss? Sign up today and get your first week free. You can cancel at any time.